biggest headline out of this, Lizanne, is that the split inside the Fed has grown larger. What are the market implications of that?
I don't think we know yet. It was a split. You had sort of 5 and 5 for nothing or 25 basis points, and you had 7 for 50 basis points. I really do think we have to take the Fed at its word these days, which is that it's a function of data dependency, not the forecasts at this point in time to judge what's going to happen at the next couple of meetings. So I think it depends on not only their mandates around inflation.
But is that a buy on stocks because the Fed's going to have the back of the markets and the economy if things turn south?
So there's part of me, I started in this business in 1986. In my first 13 years, I worked for the late, great Marty Zweig, who coined the phrase, don't fight the Fed. So that's always something that's in the back of my mind. However, the Fed even acknowledges that there's only so much they can do, that lower rates is a benefit for credit-sensitive parts of the economy, but it's not the elixir for what ails the manufacturing side of the economy. It doesn't engineer a trade deal, and that remains one of the big uncertainties. So it's not a negative, but it may not represent the same kind of positive it has in the past.
But is it even data dependency or rather data expectancy? Because this was an insurance cut, and Chair Powell admitted as much.
An insurance cut, but also remember what he said in the last meeting, which is that he still views this as mid-cycle, and he didn't say anything to deflect against that. So if the data stays relatively robust between here and, say, the next meeting, I think you may see the market start to price down expectations that this is the beginning of a series of rate cuts.
Jeff, everyone expected 25 basis points. Yes. Have you altered your expectation for the rest of this year in 6 months?
No, I think, no, we haven't. And, I mean, the market's kind of pricing in roughly one more cut. You're not seeing that from the dot plot, as you mentioned, Lizanne. There's 7 voters that came out or that give their forecast, and all voters, that said there's maybe one more cut. The idea that the market's on pause, I think, is a function of the data dependency we see from the Fed at this point. And so if you look at the data set does appear to be kind of improving a little bit. We can focus on manufacturing, which is a smaller piece of the economy, and let's say the service sector. Service sector is providing pretty positive numbers. We still see the consumer hanging in there. We know those are lagged variables. But ultimately, until you see a really big tick up in unemployment claims, the initial claims, or the unemployment rate at this point, it's pretty stable to see, or the economy should stay relatively stable at this point. We're not going to get a 3% growth rate. We never really forecasted that. No one really thinks that. We're at trendline growth. We're running at 2.5 in the first half of the year. We're running about 1.8, 1.9. I think as GDP now came out recently as 1.9. For the third quarter. So effectively, the Fed probably regrets wanting to cut. I think the market's cornered them on that side. And Powell's not telling you this is a cutting regime. What he's telling you at this point is data dependency, which says maybe I really don't want to cut anymore. Let's see if the market can stand on its own, and we don't want to go to negative rates. I thought it was pretty interesting that when he used the phrase effective lower bound today, he actually said we were at the effective lower bound. So he's trying to now go back to that point where when he introduced that, it used to be called the zero lower bound. So him saying that, to me, that's something I picked up on to say, he doesn't want to go negative. Now, we don't know what the future holds. We may have to go negative, but I think we see how problematic that is for markets globally with negative rates.
This idea that the markets have the Fed cornered, kind of reluctantly cutting rates or having an easing bias is interesting in that they don't resort to just pointing to the yield curve and saying, listen, we just need to get this fixed. It's not because we think the economy is heading for a recession. Again, Powell resisted saying that, maybe except for Bullard, who 1.5 half a point.
Well, I thought Josh said something interesting to say Bullard should have just went 75 or 100 just to get into
but do you think the yield curve is now just kind of a red herring and we don't have to worry about it?
No, I mean, look, the inversion still matters because it's still inverted somewhat on the front end. But if you look at it, really, the 2-year is exactly where Fed fund policy practically is, right? Yeah. It's a few basis points inside of there. So I think that gives Powell the out to say, look, is it really that inverted? Where most of the year, I mean, we've had a severe inversion on the front of the curve. So it's getting there. The market's response today was effectively that, okay, we see this. Maybe we should reprice this expectation of 2 more cuts this year. I think if you just kind of take the medium point here at this point, I could really see them not cutting the rest of the year. But the market's pricing in roughly 1, and that's what we have to respect at this point in time. But we got overbought in the Treasury market. We saw the negative sentiment. It really peaked in August, and the data's starting to slightly rebound. We'll see if it's just a blip in the radar or if it's actually something of a longer trend.
Lizanne, you have liked, I think, large caps over small caps. I mean, you've had these sort of consistent thematic calls throughout the year. Have you changed your mind on any?
No, looking at the action last week where the first 3 days of the week saw the Russell 2000 outperform the S&P by a full percentage point each day, that's a pretty rare occurrence. We've had 7 times where we've had a similar quick reversal like that. 5 out of those 7 times, it did not lead to persistent outperformance by small caps. We have to make our decisions based on the fundamentals, not just a shift in momentum in the short term. And when you look at the high percentage of small cap companies that are highly indebted, that are zombie companies, the lower profitability stream that they're facing, the only benefit that small caps really have going for them right now relative to large caps is a valuation discount. But we think the fundamentals still support a bias and where we are in the cycle toward large over small.
Jeff, just quickly want to ask, with the repo rate spiking earlier in the week, are there any other signs you've seen in the market that concern you about liquidity and worry you more broadly?
No, it's something we've been writing about. In fact, we put out a paper in early July about the repo facility and watching this at month end and specifically at quarter end. And it is quite surprising. I did see the announcement that they're going to do the facility again tomorrow. And I think that's right. I think they have to do it until there isn't stress in the market. They have to build confidence in this target range. And so Powell's not calling it QE. It is expanding the balance sheet by definition. I mean, you're trying to provide liquidity there. And so I think they're going to continue to do this process until the market behaves. And so it's right, they need to do it. That causes stress. And these are supposedly the good times. This is the greatest economy ever, we keep hearing, right? And so from that perspective, if it's the greatest economy, why are we having liquidity runs? So they need to fix something there. Maybe they need a bigger balance sheet. It's something that we've been focused on. And the question about the excess reserves, is there enough there? And so I think the adjustment to IOER, which really no one's really talked about today, is something to try to bring that in as well.
And you guys at Double Line still think the dollar is going to weaken?
Yeah. I mean, look, there's a supply. I mean, we already had 11 months, 11 months into the fiscal budget this year, and we're running north of $1 trillion. I mean, the forecast from the CBO was roughly about $700 billion for the year. So we're blowing through that. There's no end in sight. Congress continues to spend, and look forward. Look at the campaign trail, what you're seeing. It's all about spending, both sides, both parties. At some point, it's going to cause stress in the system, and that means ultimately a weaker dollar. The president wants a weaker dollar. That's why he wants lower rates. The reason he's asking the Fed to continue to cut and cut so aggressively, he wants to be more competitive on a global basis, and that's really what it comes down to. And I don't think the Fed's going to give him that fodder unless the data collapses.